Hi, my name is Aman and I'm a CPA practicing in the Metro Vancouver region of British Columbia, Canada. In this video, I will discuss how to deduct your primary home mortgage, how to rapidly pay your mortgage, and how to grow your net worth in less time. As a Canadian home owner, you have two critical financial goals: pay off the mortgage and save for retirement. A tax reduction strategy called the Smith maneuver can reduce your tax bill, eliminate your mortgage debt quicker, and enable you to start investing in your future regularly. There are certain steps that you need to take to implement the strategy. Step 1, get a re-advanceable mortgage on your primary residence, personally used properties. The key here is to start with a re-advanceable mortgage. Well, a re-advanceable mortgage is a mortgage that allows you to increase the home equity line of credit as you pay down your mortgage. As you pay your monthly mortgage payment, your line of credit availability increases and boom, you can now borrow more from your line of credit. Let me explain with the help of an example. Let's say you regularly make a $2,700 monthly payment against a $550,000 mortgage, with $1,700 of this monthly payment going to the bank in the form of interest and $1,000 going towards reducing the principal balance on your mortgage. A re-advanceable mortgage will let you re-borrow the $1,000 you pay off every month to invest. By continually reusing the space available in your line of credit to invest, you will be able to grow your investment portfolio each month without having to access other personal funds or credit lines that may charge a higher rate of interest. Moreover, if you borrow from this line of credit to invest in stock, or let's say buying an investment property, the borrowed funds interest is tax deductible. Step 2. Use your after-tax earnings, extra savings to pay down your home mortgage. Generally speaking, your primary residence mortgage interest is not tax deductible here in Canada. If you have extra cash available for investment, immediately you can first use your extra cash to pay off your primary mortgage, which in turn increases the line of credit available for investment. If you were to continue with the same example I gave in step 1, you would still owe $550,000 on your mortgage after a year. Still, approximately $12,000 of it would have been borrowed to invest. When tax season comes around, you can receive some tax relief from these reinvestments, as the interest on the reborrowed funds will be tax deductible. If you receive a tax refund, you can choose to pay towards your mortgage balance, which of course will help you pay off your mortgage balance quicker. If you wish, you can then reborrow the amount you paid off on your mortgage to continue investing. Word of caution though, if you borrow to invest in TFSA, RRSP, and any registered account, chances are the interest would not be tax deductible. Step 4. Keep up your paperwork for a year-end tax deduction. By transferring cash the proper way and taking advantage of what is available from the mortgage terms, you are now making your primary home mortgage interest tax deductible. Please remember that you need to keep track of your paperwork, all the transfer slips, deposit details, to ensure that you can prove that the funds from your line of credits are used for investment purposes only. Make sure you keep the document until you fully repay the loan. Step 5. Rinse and repeat. You can rinse and repeat with your savings, turning your non-deductible primary home interest to deductible investment interest. Several risks need to be considered before you go for the Smith maneuver. The financial benefits of tax deductible mortgage interest are indisputable and justify the risk to the right borrower. Any tax refund should be used to pay down the mortgage as quickly as possible. thus making as much of the interest payment as possible tax deductible. That said, a problem can arise if you spend the funds instead of reinvesting them or reinvest the funds in declining assets. You see, the short-term financial risk is liquidity, sometimes referred to as cash flow risk. Some readvanceable mortgages have interest rates on a floating basis. So, an increase in the prime lending rate could result in higher interest cost. Lenders of readvanceable mortgage could also either lower their credit limits or demand repayment anytime, as readvanceable mortgages are not subject to the regular terms and conditions as typical term mortgages. You see, the cash flow risk addresses the possibility that the interest rates will sharply drive up the cost of borrowing at the same time as the markets falter, resulting in a negative monthly cash flow for a brief period of time. So this is a risk, but this is a short-term risk which is typically only prevalent in the first, let's say, 2 to 4 years, because after this period of time you might have already stockpiled enough equity through annual tax refunds that other liquidity option exist and the risk is fully mitigated. Liquidity risk varies widely based on the strength of your balance sheet. In a nutshell, borrowing to invest is never straightforward but can be a very lucrative option. Before implementing any strategy, I would recommend talking to your chartered professional accountant, in short form CPA, who will work closely with your mortgage broker to restructure your finances. Remember, if you get it structured properly, the once tax inefficient mortgage becomes a tax efficient investment loan that can be leveraged to increase your net worth. If you want to be notified about our new tax updates, please consider subscribing to our YouTube channel. Thanks for watching and see you in my next video. Bye.